Hey, everybody. Welcome to this evening's class on life insurance to create wealth. My name is Hone, and I will be your host for tonight. Today, we're going to be going over all types of ways to use life insurance policies to make you wealthier. And this is something that not a lot of people go over because not a lot of people know about it. So when I found out about this, I said, you know what? I definitely have to bring this to the masses. I have to show them. The thing that I find is that people are just lacking information and they don't know anybody else who knows about it. So then people never do it. And I think that's the biggest reason why people don't have life insurance. It's just that they don't know that this process exists. Most people think when they hear life insurance, what they think, death benefit. Oh, life insurance, that's that thing that you buy. And in case you die, your beneficiaries get paid. That is true if you're getting a term life insurance policy. But what we're going to be talking about are policies that have cash value that allow you to build wealth and do more investing. So let me start off with a little PowerPoint presentation. Okay, so here we go. So this is me, Hone Tai, investor, lender, educator, insurance broker. And today what I'm going to be covering, I'm sorry, I didn't even share it yet. Here we go. Now I'm sharing it. But what I'm going to be going over is how to do more deals as a real estate investor, how to create a retirement income, how to do kids savings accounts, and then also have a family legacy bank. So those are all really interesting things that I didn't know that I could do as a life insurance policy holder. I was just taught, again, like many of you, that life insurance is what you get when you die. So that's what I'm going to be doing, is going over how to use these policies. Also, I want you guys to understand that the rich do things differently and that you can too. It's not a special club that you're not invited to. You're invited. You just have to say, I want to be in it. That's actually a conversation that we were just having, that everybody, here's your ticket in. Now do something about it. We all have this equal opportunity. I'm not only teaching a man or a woman how to fish, I'm giving you the fishing rod, I'm giving you the bait, I'm pushing you to the water, I'm giving you gas for the boat. Like, here it is. It's now time to do something with it, right? So some of the pitfalls that people run into, it's that the agents that they deal with, the life insurance agents, this is one of the biggest problems, that they're not investors. They don't know what to do with these policies. Also, the agents are commission driven. They don't really care about how well you do. They just want to make money. They also take advice from people who don't understand how to use these policies. They're like, oh, you don't need one of those. Do this instead. The number one problem with most things is that you think you already know what this is and you don't, right? So you think you already know, but you don't. And that's a big problem that I see from a lot of people. Even with real estate investing, I talk to people and I'm like, how come you don't invest in real estate? And they say, oh, Hone, it's because I don't have money for the down payment. And I'm like, well, what if you didn't need a down payment to invest in real estate? What if you were buying properties without using your own money and without using your credit? And they're like, what do you mean? And so a lot of times people don't do things because they think they already know how to do it. And because they think they know how to do it in a certain way, and because they can't do it that certain way, they rule it out altogether. So a little bit about me before we get started and why I'm even in this thing. So I've been a real estate investor for 9 years, back in 2011. I wanted to be an investor in 2011 because I read the book, Rich Dad, Poor Dad. I'm sure some of you guys have read that book, and some of you guys got interested in investing in real estate because of Rich Dad, Poor Dad. So I read the book and I did absolutely nothing for 2 years. 2 years. I just couldn't figure out how to get started. Every time I tried to invest in real estate, I would look at a property I wanted to buy. And I remember wanting to buy this property. It was $200,000. And then to get a bank loan, it would have been $60,000 down. That's 30%. And I was just like, dang, that's a lot of money to put $60,000 down to buy one property. And I was going to rent the property out. And I was doing the math. On how long it would take to break even from the cash flow. And it was 8 years. So that means if I did that deal the way that I thought to do it, I would have broken even last year. I would have broke that. I had never invested in real estate before, but something tells me that wasn't exactly how investors did things, right? So I struggled. I was just like, how do they do this? How do you buy 5 properties or 10 properties? Are they buying one property every 8 years? this makes no sense. So I was like, all right, I'm gonna just have to put it on the shelf. This idea of buying assets and all that kind of stuff, it sounded great, but I just don't know how to do it. I went to a seminar that taught me how to do cool things like cash out refinances and what they call the BRRRR strategy today. I did that as my very first deal. When I figured out how to do the BRRRR strategy, I was able to refinance all my money back out within the first year, actually within 8 months. And that break even within 8 months, I was like, oh, that's how they do it, right? So I broke even in 8 months instead of 8 years. And then I learned how to raise money, how to use retirement accounts, all of those kind of things. And that completely changed the game for me. So my last slide that I just put up was the one that said, the rich do things differently. And I want that to sink in for a little bit. So one of the cool things that the rich do is they have self-directed retirement accounts. If you've never heard about a self-directed retirement account, you want to look into that. So they have self-directed retirement accounts where they put money into their account. They buy real estate or they lend money from their retirement account. And all of the profits from the rental or the retirement account, or they do flips, all of that money, all the profit goes back into their account completely tax-free or tax-deferred. If they do it through a Roth IRA, it's completely tax-free. One of the early investors of Facebook, Peter Thiel, he used his self-directed Roth IRA to invest in Facebook. And then Facebook exploded, as we all know. And now his Roth IRA is now worth like $900 million. And when he starts pulling that money out at the age of 59 and a half, guess how much he has to pay in taxes? Bingo, zero. And it's zero because he's playing by the rules. Now, imagine, right? Of course, the headlines are going to read, wealthy investor pays no taxes. And everybody's going to have the pitchforks and be like, no, like, boo, kill them. It's like, whoa, don't be hating. You have access to the same tool. It's just nobody taught you, right? So that was one of the ways that the wealthy do things differently to build wealth. The other thing I mentioned earlier was that cash out refinance. If I did things the way everybody else did them, I put a down payment and all of that kind of stuff, I would not have broken even for 8 years. But because I learned about the cash out refinance, I learned about the BRRRR strategy 9 years ago, I was able to do my first deal and get all my money back out within 8 months. The other things are like when you're acquiring properties, doing subject to seller finance or syndication. Those are all more strategies that the rich use. And if you've never heard of those things, you can't do them. So one of the biggest takeaways that I want you guys to have, one of the biggest takeaways is that the rich do things differently. And if you feel like you already understand and know, but you don't really, that's going to hold you back. So you have to be really open-minded, because if you didn't get taught these things, then how would you have known, right? How would you have known? So for me, being open-minded, going to seminars, learning things, going on Zoom calls like this, learning from industry professionals completely changed my world. So for you guys, I applaud you, because a lot of people aren't on here, right? A lot of people, you guys are on here. And this information will take you another step further. And so I learned about life insurance recently from my mentor in this industry, MC. He taught me how the wealthy use life insurance policies to create more wealth. I kind of had an idea that people were doing it. I didn't know how it worked. Show of hands, some of you guys that way, right? You heard about it, but you just didn't know. It's like, all right, I know you can do it. I just don't know how it works exactly. And I was stuck there. I was stuck there for years. I've known about this for years and years, because in Rich Dad, Poor Dad, Robert Kiyosaki, he talks about that too. He's like, the rich use life insurance, and you got to focus on the life part of life insurance, not just the death benefit. And he kept saying that. He was like, there's the life part. And I was like, what the heck are you talking about? And I didn't understand. And I'm glad that I didn't hop in with the first life insurance person that I met, because like I was saying earlier, the biggest problem is the agent. the agent doesn't know what they're talking about and they're only driven by commission, that's a problem. As transparency, if you guys get a policy from me, I will get paid a commission. But I have minimized my commission. And this is the key. So any policy that I write for you guys, I am reducing the commission as small as possible so that your policy operates as efficiently as possible. I don't care to make my income from life insurance policy commissions. That's like not how I make my money. I make my money from real estate, but I learned about this stuff and I said, I have to become the agent that doesn't exist out there for all of these other people. So that's why I became an agent, to help you guys become better real estate investors. My whole goal, I teach you guys how to become investors, and then I show you tools to use to be better investors. Self-directed retirement account was one of those things, using creative acquisition strategies like subject to seller finance syndication, raising private money, right? And now life insurance policies. Commissions are one of those things that agents don't talk about because they don't want you knowing how much money they make, because they think like you're going to be upset. And maybe you should be, because they're getting paid too much. I focus again on minimizing the commission so that your policy works the best. So that's why I am a life insurance policy or a life insurance broker now, because I want you guys to have another tool to become better investors. And when you guys are better investors, we're all better investors, right? So let's go back to the slideshow. Let me show you guys how to view this policy. All right, so now here's the death benefit, right? Right here on the right side. Everybody, when they think life insurance, they think death benefit. There it is. But it's these other two parts that you never think about. So it's protected cash to do more deals, and then also tax-free retirement income. So I'm going to be showing you guys how life insurance has all three of these features. I used to think it was only death benefit. So let's go into the other two. The way that I create policies, the way that I design them is to have 30% death benefit and 70% cash value. That is the maximum amount of cash value to death benefit that I can do, that anybody can do, that allows for this to still be called a life insurance policy. So let me explain. A life insurance policy has two parts: death benefit and cash value. When a typical life insurance agent creates a policy for you, they are going to maximize the death benefit and minimize the cash value a lot of times. Why would they do that, you think? Because you get paid on the death benefit and not on the cash value. Now, you're like, okay, well, Hone, if that's the case, then why don't you go 99% cash value and 1% death benefit? And if I could, I would. But if I do, it is no longer called life insurance, because life insurance has a death benefit to it. So I maximize how much cash value that I can give you and minimize the death benefit so that you have maximum cash to use it while you're alive, right? So while you're alive, that cash value is super important. Okay, we got our first question. How's it going, Letitia?
Not a question. I just wanted to make it clear for those who don't know that like term doesn't have cash value.
Yes. Thank you. Thank you for that share. So a term policy would have 100% death benefit and 0% cash value. So that's a good pickup. So what I'm talking about today, and I think that was a perfect comment, is I'm talking about creating a whole life insurance policy. Now, other agents will try to sell you a whole life insurance policy. But the thing about that is they don't necessarily create it where you maximize the cash value. That's the important part, maximizing the cash value, because that death benefit is what they get paid on, right? There's almost a conflict of interest. If they maximize your cash value and minimize their death benefit, they're minimizing their commission. And for them, this is their full-time gig. So I understand why maybe they maximize their cash or the commissions. This is not my full-time gig. This is something that I'm bringing to you guys as a tool to become better investors. I want you guys to get loans from me. I want you guys to get life insurance from me. I want you guys to become a real estate investor student of mine, right? I want you guys to be in the ecosphere of everything we're doing, and I want you guys to join the wealthy few. I'm putting it all out there. So I don't mind minimizing the death benefit to minimize the commission to maximize your cash value. So that was the breakdown. Of the policy. Let me see. There we go. So that's the breakdown of the policy. Now, this is a simplistic version of it. It's not really like that. There's additional riders and things like that that we add into the policy that make it this way. This is just a simplistic way of looking at it. Again, if the death benefit was any smaller, it would no longer be called life insurance. And if it's not called life insurance, it misses out on some of the benefits, the tax benefits and the asset protection benefits that life insurance offers. So that's why we created it so that it is still a life insurance policy. Okay, so let's get into the meat and potatoes of it. So this is a policy for a 38-year-old male where they're putting in $12,000 a year. So this is an illustration. I want you guys to take a look at it. So this is $12,000 a year. So what happens is every single year you're putting $12,000 in. This column here is how much you've put in over time. So $12,000 year one, 24 because it's 12 plus 12, and then 36, 48, 60, right? So that's you paying $12,000 per year, and this is the cumulative, okay? Everybody's following along so far, pretty easy. So after 20 years, you will have put in $240,000. Great. So here is the cash value. And so you'll see that it's got two parts. It's got the cash value here, and it's got the death benefit here. So when you put $12,000 into it, $9,000 goes into the cash value, and you have $516,000 in death benefit. The next year, you put another 12 in. Now your cash value is at almost 20. Bing, bing, bing. Around here, around year 5.5, you're about break even. And if you're at break even, what's cool is you still have this death benefit. And it's kind of like term death benefit, but for your whole entire life. Most people, if you guys have a term policy, it has a finite time frame. It's either like a 10-year policy, 20-year policy, 30-year policy, something like that. This policy is for your whole life. And why that's important is because most term policies expire worthless. What that means is you're never going to actually see the money. You've paid and paid and paid into it for the last 10, 20, or 30 years, and then you've got nothing in return for it. Whereas here, unfortunately, one day you will pass away. Okay? One day you will pass away, meaning that death benefit will be used. That death benefit will either go to your family, go to your family bank, or it will go to a nonprofit that you want to give away to. Like, you can do all kinds of fun things. So maybe you guys don't have a family and you're like, well, I like SPCA. So I'm going to give my money to the animals, whatever it is. It doesn't really matter. It's yours to give. So now, why in the world would I use this policy? Why do I care? Well, it's because of the growth. So if you see here, you're paying $12,000 and you get $9,000 here, right? This is the change in total net cash value, meaning how much goes in every single year. So if you see right here around year 3.5, you guys can see this, right? Put a thumbs up if you guys can see this, okay? I can see you guys, so thumbs up. All right, cool. So this is cool. All right, so around year 3.5, you put 12,000 in, your cash value grows by 12,000. So here we're about break even in terms of I put in $1, I get back $1. And then every year after that, it snowballs like crazy. So here I put in 12,000, I get back 24,000. And what's really nice about that is this is completely passive. I don't have to work for this. This happens. This just happened. So every year after this point of 3.5 years, every year after that, I put in 12 and I get all of this extra growth. And that goes into my cash value. What can I use my cash value for? Anything I want. So let's jump into that real quick. So here's an example. Here's my cash value, and it's been building and building and building every single year. And then what happens is I can take out a policy loan against my cash value. I can take that money out and I can go buy a house. Now, maybe I can only pull out 20,000, and you're like, oh, that's not enough money. That's fine. then I'm going to pair it with a bank or a hard money loan. I'm going to use the money that I have access to plus leverage, whether bank or hard money loan, combine the two, and then buy the property. And if this is a rental property, boom, it goes right to me, the cash flow. And then I use some of the cash flow to pay itself back. Now, Raul was talking about he is a flipper. So the nice thing about this, how you can use this as a flipper is, let's say this was a hard money loan, okay? This is a hard money loan. And if anybody knows how hard money loans work, you usually have to pay for the closing costs, transfer taxes, the title insurance, the blah, 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 right? You got to pay for all these things. The hard money loan will come in, give you some of the, all or some of the acquisition money, and then all or some of the rehab, right? They're not just giving you all of the money that you need. You're still going to have to pay for closing costs and things like that. So you're going to use this money to pay for the closing costs, maybe the first draw, the rehab, things like that. Then the hard money loan is going to come in for the rest. Now, the hard money loan is going to ask that you pay them interest monthly, usually. Usually it's not deferred to the end. So they're going to want their money monthly. But the loan against the cash value, you do not have to pay monthly. You do not have to pay annually. You don't have to pay it back at all if you don't want to. The only problem is if you don't pay it back, you can't borrow against it again later. But that's the nice part. Your cash flow isn't disrupted by that loan. Again, you get to pick and choose the structure in which you pay back that loan. So if you want to do more deals, now you have access to money that is available that you can combine with a bank or hard money to do the deal. Now, if you have enough money in your cash value, then you can buy whatever you want. You can buy whatever it is that you want. So let me open it up for questions. So does anybody have questions about that? I like this to be a conversation, because if it's just me talking, it's kind of boring. So you're combining it with bank money, hard money, private money, whatever you want. You put the money in with your bank loan or your policy loan, and you go buy a property. You pay back the loan, and you're off to the next one.
Hone, I had read that that when it's in the account, it's earning anywhere between 6 to 7, depending on who you have the policy with. If you take money out of it, that money that's taken out is not earning interest. Is that correct? Or does the amount that's still in there still earning interest?
Right. Okay. So what's awesome about what Dylan asked is like, hey, if I take the money out, is it growing? Is it still growing? And if you take the money out, it is not growing. That's why I said it's a policy loan. So let's go back to let me go back to the sheet that I showed you. And that was a good question, Dylan. Okay. So we're back here. So now in year 1, I put in 12,000. I got 9,471. In year 2, I get 10,374. Year 3, 11,555, blah, 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 right? If I take my money out, I reset the clock. You don't want to do that. So that's why I was saying we take policy loans against the cash value. So the life insurance policy, or I'm sorry, the life insurance company is actually lending me money in the form of a loan against what is in this cash value here, right? So if say I had $60,000 in my cash value and I needed, say, $40,000, I would take a loan for $40,000 from the insurance company. Because I took a loan for $40,000, I did not actually touch this money. You guys get that? It's really cool. It's a subtle thing. Imagine, and I'll just use people as an example. So like, let's say I needed money and I met Dylan and I said, Dylan, I have $60,000 in the cash value of my life insurance policy. Dylan, will you lend me $40,000? If Dylan says, sure, I'll lend you $40,000, right? That means this money here is actually not touched. Do you guys get that? So it's going to continue to grow every single year the way it's showing here. So do you see how much more I'm getting every single year? So now Dylan was asking about the dividends. So there's two different things. There's the dividend that's paid out on the money that's in there. But then there's also the growth of the cash value that's in there. Those are two separate things. It's kind of confusing. The dividend is how much they pay you for the money. The cash value is kind of like this gift that the life insurance company gives you that you can use for whatever it is that you're trying to do. And that's why it grows so fast. If you look right here, this says change in net cash value. It's almost $6,000, meaning I put in 12,000. My policy grew by 17,934. That means I'm getting an additional 5,934. If you do that as a percentage, that's almost 50% growth in my cash value. This is why I care about this. I'm putting money away in this policy. I have a death benefit just to cover my family. I'm not focused on that because I don't plan on dying. I plan on living forever. While I'm alive, though, I have this cash value policy that's growing and growing and growing at this super rapid rate. And it's growing at this super rapid rate, which allows me access to more money, right? It allows me access to so much more money when I'm trying to build up my portfolio of real estate properties. My goal is to buy more properties, have access to more money. This gives me access to more money. So does that help? So Dylan, does that clear it up for you? And anybody else, do you guys have any questions about what I just covered?
I have a question.
Yes, Teresa.
I think about my battery's dying. You're loaning money to other people. There's no SEC guidelines or like they don't care if you're personally loaning money out to somebody else off of your whole life or no?
So we're diving deep. We're kind of a little tangent, but she asked a question: if you're lending money from your whole life policy, which is something that you can do. So instead of me using the policy to buy a property, maybe I use that money and I lend it to Letitia so that she can go buy more vending machines. If I lend her the money, I mean, that's my business with her. Now, she could possibly get in trouble for borrowing the money when it's outside of the guidelines of the SEC. But for me lending it, I don't get in trouble. But that's another way you can do the business. You can lend it to people so that they can borrow the money. They'll pay whatever rate of interest that you decide. And that's completely passive now. So I have this cash value. It's growing and growing and growing at this super fast pace. And then I go out and I lend the money. Maybe you don't care about real estate, but you're interested in business. So then I lend the money to people who I know are good operators. This is like my soapbox. Like, guys, when you lend money, make sure that person is a good operator. Make sure that they know what they're doing. Make sure that you know what you're doing so that when you lend the money, you don't lose the money. But there are plenty of good operators out there who can run a business, who can invest in real estate, and who can use that money and grow that money and pay you a good rate of return while doing it. So if I choose, I can lend the money. In terms of SEC, that's up to you to figure that part out. I don't want to go too deep into that. So Jermaine asked the question, is there a limit to how much you can contribute to your policy? Is there a max percentage you are allowed to borrow from your policy? So there is a max you can contribute to the policy, which is, I believe it's 25% of your income is how much of a policy you can get. So if you wanted to do a $12,000 a year policy, then you got to make at least $48,000 a year. And then in terms of the max percentage you're allowed to borrow from your policy, it is 90%. So you can go up to 90% of your policy for whatever you want to do. And here's the thing. They're not going to ask you, so Jermaine, you want to borrow 90% of your cash value, I see. What do you want to do with it? They're not going to ask you that. If you want to borrow it to give to me, like, that's fine. Nobody's going to question it. I'm not going to question it. So if you want to do that, Jermaine, feel free. But yeah, you don't get questioned for anything like that. All right. So let's see. Let's go. Corey has a question.
I have a quick question. So let's say you want to do a hard money loan at like 10% and you take out the loan at 5%. What do you do with the 5% that you made? Like, does it have to go back into the policy, or how do you separate that out from what you owe them?
Great
or
question.
what you owe yourself, I guess.
Great question. So for those who didn't catch that, there is going to be interest on the loans that you take from your policy, and it's going to be 5% interest. Now, Corey asked, if you charge someone 10%, so there's an extra 5% in it for you. Where does that go? Does that go into the policy? The answer is no, it doesn't. That money is for you. What people get mixed up sometimes is a self-directed retirement account versus a life insurance policy. Like I mentioned earlier, a self-directed retirement account, when you're lending that money or you're buying a house or whatever, I had said all of the profit goes back into your retirement account completely tax-free or tax-deferred. That is not the case with a life insurance policy. When you take that money out as a loan and you go lend it out and you go do business with it, whatever that money makes you, that money makes you, not your life insurance policy. The only thing you owe is that 5% on the loan. And if you ever want to borrow it in the future, make sure you pay back the loan. Nobody's going to chase you though. If you don't pay back that loan, nobody's going to chase you for the money. So that's a little bit of the difference there.
Does that, Hone, does taking it out count, or does the money that the interest that you pay to the loan affect the amount you can contribute?
I'm sorry. Ask that one more time, Bill. To the money that you take out. He's like, my kids are so loud. I can't.
They are very loud. So the money that you have to pay back for the loan, let's say you have to pay back that 5% interest on 60 grand, right? 5% interest on 60 grand over the year is what, like a couple grand. Does that count against your 25% contribution rate?
It depletes your cash value, but it doesn't go against anything like that. If you don't pay it back, it doesn't go against anything, but it depletes your cash value if you're not paying it. Okay, so we got a couple of questions here. So Tisha asks, how does the repayment work? Will your premium increase if you do not repay the loan? What is the penalty for the cash value decrease? Will the policy get terminated? So what's really cool is the repayment is whatever it is that you want it to be. If you want to pay back daily, fine. Monthly, fine. Annually, fine. Never, fine. They don't care. Will your premium increase? That is the super, 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 super nice thing about this whole life policy is that premiums don't ever increase. They are flat and fixed for your whole entire life. Unlike an IUL, which can go up and will go up as you get older. Just when you need the money the most and you want to work the least, they're going to hit you with a higher premium. You know why? Because an IUL, which stands for Index Universal Life, has an investment side and a death benefit side, right? And so the death benefit side is based off of what's called a renewable term. They readjust your insurance, your death benefit insurance part. They readjust it every single year based on your age. And the older you get, the more expensive it gets. So it's fine as this age, pretty much everybody on this, it's fine. It's when you start getting to your later 40s, mid 50s, and then you get to 60s, and then you're like, I can't afford this. And guess what? You're probably not going back to work, so it's even harder to afford it. So here's a good thing, bad thing, whatever. You have a death benefit associated with it. And when you reach the ripe old age of say 60 or 70 or something like that, people think you're going to die. And so what they're going to do is they're going to be like, oh, Tisha, as I understand it, you have this IUL policy and you can't afford it. Well, I did notice that you have a $2 million death benefit. We would like to pay for your policy, right? We will like to pay for your policy. And for your troubles, we'll give you $300,000. All we want in return is that when you die, that death benefit goes to me. So you sold your death benefit to somebody else. It's a $2 million death benefit. So if I did that, I would be receiving $2 million when you die. All I needed to do was give you $300,000 up front and then pay for your policy to be current until you passed.
What's that term called?
Viatical, something like that. Viatical.
Medication.
What is it?
I'll type it in the chat.
you.
Yeah. So that's so for all of you guys looking for an interesting way to become investors, you can invest in death benefits of other people, interestingly enough. And the ones that get sold the most, IULs, because people can't keep up with the cost. A whole life policy is a fixed cost throughout. Now, if you guys have IUL policy today, you can do what's called a 1035 exchange. So if there's cash value in your policy, you can roll it over into a whole life policy.
Okay.
So you can move and shake. Vatical
Okay.
settlements. Okay.
Yeah. Thank
Okay.
you.
Yeah. So other questions. As a flipper that wants access to funding from a retirement vehicle, can you just put money into a whole life policy instead of a self-directed IRA? So I personally, as a real estate investor, I have both. I have a self-directed retirement account and I have a whole life insurance policy. They are two different vehicles. They do completely different things. And sometimes you do one versus another. And that conversation is a little deeper. It really depends on, I guess, it's almost like how smart are you in terms of what strategies do you know in order to make more money? What I'm trying to ultimately do for all of you guys is I want you guys to have the mindset that the wealthy have. Would you guys agree that those who are like rich and wealthy, they think differently? They don't just like work harder and harder and harder. They're not like grinding until like whatever. They do work hard, but they also think differently. If you've ever met rich people, like I hang out with rich people all the time and I'm talking to them and I'm talking about how they grow their assets and things like that. It's completely different. What I'm trying to do with all of these seminars that I do and webinars and things, I just want you guys to be able to think differently and also learn how to use the tools that they know how to use. So to Raul's question, as a flipper, do you use a retirement vehicle or do you want to do a self-directed IRA? As a flipper, I would actually prefer to do a life insurance policy versus a self-directed IRA, because when you're flipping, a lot of times you want that money to be used today. In a self-directed IRA, technically you're not supposed to touch any of that profit. That's supposed to be retirement money. So you're not supposed to touch that money. But there are some cases where you might want to do a self-directed IRA and do a deal that way. Doing real estate within self-directed IRAs gets a little complicated if you don't know of all of the prohibitive transactions. One way to get around it is by creating a LLC that's owned by your self-directed IRA. So you have a self-directed IRA that owns an LLC, and then that LLC does its deals or does the deals for you. It makes it a little easier, but you still don't have access to the money. Again, anything you do in a self-directed IRA, that money goes back into your IRA. Any money that you make using a life insurance loan, that's your money. So if you do a flip using your life insurance money, any profit is yours to use. It does not go back into the life insurance policy. The life insurance policy grows by itself. You do not make it grow any faster or any slower. It just does what it does without your input. Your self-directed IRA only grows by your input. If you do nothing, it does nothing. So they're two completely different animals, two totally different animals that have their own ways of operating. Your job, have conversations with me weekly or whatever you want, and let's figure out how to use both in the most appropriate and most effective way. Cool? Okay. Any other questions? Did that clear up a lot? Like this conversation is opening up like your brains to a whole bunch of things, huh? Yes, Letitia.
I'm confused. How does the IRA know what you've invested in
Because you
and how
told it.
much you've made?
Because you told it.
Oh, hell no. So do they ask for like tax documents? Like how do they know what you made off of your investment?
Well, let's think for a second. So if you're going to do a flip and you bought the
Yeah.
property. So if you're using retirement account money to do a deal, um, and thank you for this question because it opened my brain to another aspect of it that makes investing within your self-directed IRA a little bit more difficult. So let's say you had enough money in your self-directed IRA to buy a property, fix it up, and then sell it. Well, everything that you do within your IRA, like you're going to need to buy the property in your IRA's name. So they'll know that, right? They'll see that part on the deed. The rehab, you're going to have to buy using the IRA funds. You're not allowed to pay for the rehab stuff. You have to use the IRA money to fix it up. Now, if you don't and you do a little here, a little there, I mean, technically you're going against the rules. Will they know? I don't know. And then when you sell it, they're going to see the check. They're going to see the check, and then they're going to be like, okay, well, you made this much. That much better go back in. So you don't get any of the proceeds because it doesn't happen in your name. It happens in the IRA's name. So
Okay.
it needs to go back in. They can see your
That's
purchase.
why you said you have to create the LLC in the IRA's name.
Yeah. Well, no, not the LLC is going to have its own name. The LLC is going to have its own name, but the LLC is going to be owned by the IRA.
Okay.
Right? Paul saying forensic financial accountants or audits can find shenanigans. Yeah, that's their job. So you can choose to push it or not. So the other thing that I was going to say is that when you're investing the money that you have in your retirement account and you're trying to invest it into buying a house, you may not have enough money in there to actually buy the house. So in order to, for all of us in real estate, how we often buy houses is we use leverage, meaning we're using other people's money, whether it's bank money, private money, hard money, you name it, we're using somebody else's money. When it comes to a retirement account, it's so much more restricted when you're trying to leverage that money. So if you had $50,000 in your retirement account, but you needed 150, it's going to be pretty difficult for you to get the additional 100. You can't just provide it. Other people can't just lend it to you. There's a way of going about it. And you can't go like, oh, here, here's the addition and all that kind of stuff. There are these like strict rules. So sometimes it's hard to combine that money with other money. But a life insurance policy loan, you can combine that with anything. Like it's super easy to use. It's super flexible. And the other thing is like, if say you had an extra $12,000 a year, right? Let's just say. So some people are like, Hone, I came into some money. I got $12,000. What should I do with it? So I first say like, spend $2,000 and get an education. And then with the $10,000 that's left over, maybe put it into a life insurance policy, because what are you going to do with $10,000? You're not going to grow it. You can, I guess, maybe lend it, but it's still not going to do much. You still have to like make that 10,000 be a little bit more. So maybe $10,000 in your life insurance policy this year, another 10,000 next year, another 10,000. And before you know it, you got a sizable amount. Then you can do something with it. But in the meantime, you got to put it somewhere. And where do you put it? You have choices: self-directed retirement account, checking account, or life insurance policy. I'm just showing you guys today how to use a life insurance policy to hold your money. I want you to understand this. The life insurance policy is not the investment vehicle. People often go, oh, Hone, I can do so much better with this money and that money. Why do I do a life insurance policy? I'm like, why are you comparing this to the investment? So you might say like, Hone, my returns in real estate are so much better than your life insurance policy. Why would I put my money in your life insurance policy? Because that's all you're doing is you're just putting it in there. Don't compare an investment to a savings vehicle. I'm looking at the life insurance policy as a savings vehicle that allows you to still do more investing. Luke, did you have a question?
Yeah, I had a question about like premiums. So, some policies you have like a steady like agreement in your contract of how much premium you put in, and by premium, the more you put in, the more cash value you get. However, say that you're paying a steady stream every year, but 1 year, you find yourself, you have extra money. This might be a dumb question, but you can put more of a premium down, right? Or do I have to just put like the agreed upon amount every year?
Okay,
Does
so
that make sense?
absolutely. Okay, so the question is, can he vary how much he pays into his policy? So he might come into a windfall of money. He might be like Raul and does a flip, and he's got $50,000. What do I do with this money? Can I just shove it into my life insurance policy? With this policy, the answer is no. The way we design it, it's supposed to have a certain amount of your premium is fixed every single year. But with a little asterisk, we can design it to kind of answer, I think it was Dylan's question about if I had a lump sum of money in the beginning, could I just dump that lump sum of money in the beginning and then maybe pay less for the rest of the year or something like that? So if you created a policy where you dumped in a lump sum in the beginning and then we did a fixed amount throughout, and then you came into more money, we can dump in the more money later. But that's a unique situation, and I can design it that way. Without going into like too much detail, the answer is yes and maybe no. If you want the policy to be the most efficient policy period, right? The most efficient policy period, you want to pay the premium exactly flat the whole entire time. If your policy is $12,000 a year, then you're going to pay $12,000 a year. But if you expect that you're going to have these lumpy payments, then we can design it to be lumpy. It just won't be super efficient. Also, oh man, I totally forgot what I was going to say next. So whatever. So the answer is yes and no. If you want it super efficient, pay it flat. If you know that you're going to be lumpy, then we can design it that way. Oh, I remember what I was going to say. You also are not fixed to having one policy. So let's say you guys buy a policy today and we create it and it's a nice flat policy. When you guys come into more money, or maybe you get a higher paying job, or you buy more real estate that produces more cash flow from rentals, you buy another policy. And so now you have 2 policies growing, or 3 policies, or 4 policies. So you can always add more policies to your life.
That makes sense.
Yeah. But I can design it however you need, Luke, and anyone else. So yeah, you can have a flat policy, or you can have a lumpy, and then you can also have multiple. Some people, what they do is they have a policy, they do a real estate deal, and then when they make more money, more cash flow from that real estate deal, they buy another policy with the cash flow. And so now they have this new policy being funded by the cash flow of the real estate deal, which then builds up cash value to allow them to do what? Buy another property, to do it again and again and again. So, all right, let's keep on moving. Let me show you something. So that's the cash value part. It grows at this rapid pace. Let me show you the next little bit of it. Let me show you the next page of it, actually. All right, so this is the first page. This is year 1 through 20, right? It takes me to age 57. I have $381,000 in cash value in here now. My death benefit is $1.2 million, and all I've paid is $240,000. So this is a good spread here. Over here, I put in $12,000. My policy grows by $30,000, which is an $18,000 premium above what I just paid, right? I put in 12, I get back 30, and my death benefit is 1.2 million. So that's cool. But the death benefit, again, does not matter because I'm not going to die, just like you guys. The death benefit is not what's important. Let's go into the next page. Let me zoom in a little bit so you guys can see this. Oops. All right. So what I want you guys to notice here is cumulative premium outlay. I've paid almost $400,000 into the policy, but my cash value has grown to $950,000. At this point, I put in 12,000. I get back 57,000. This thing is growing like a weed. This is why I do this. But this requires you to have discipline and a little bit of long-term thinking, right? That's all. Why most people don't do this? They don't have enough long-term thinking. That's their problem. The death benefit has grown to $1.8 million. At this point, I'm like, I am calling it quits. I am done with all of this. I'm just going to take my money and I'm going to go. So what's cool is this policy can create retirement income. This column here is my retirement income. I am pulling $71,214 out of this policy every single year. So this policy is doing it for 18 years. So we do some math. Okay, we do some math. Also, I stopped paying into the policy. You see it's zero here, right? I stopped paying into the policy. I'll do 71,214 times 18 years. $1.28 million is what I'm pulling out in terms of cash. This is my retirement account. This is a 401k replacement. Instead of doing a 401k, I'm doing this, and I'm going to have $1.28 million that I get to pull out from this policy from the cash value that grew and grew and grew. And what's cool is I'm never going to pay this back. I'm just going to die. I'm going to pull this money out. I have all this money, and then I die. And then the death benefit gets paid out to whoever I want, whether that's my kids, whether that's a nonprofit, whether that is whatever, that's your prerogative. And I will show you something else that you guys get to do with the money later. But for now, I want you guys to see this page. I put in $400,000. I pull out almost $1.2 million. Think about your parents who have a 401k or an IRA. Will they have enough for retirement? Well, maybe not. But this is a way for you guys to start planning for retirement and have money that you can use today. Most retirement accounts, most 401ks don't allow you to use the money. And if you want to borrow the money, they're only going to allow you to borrow $50,000. $50,000 or 50%, whatever is less. Here, you get to use 90% of your cash value. At the highest point, we got to $950,000. You get to use 90% of that. That's hundreds of thousands of dollars you get to use for whatever it is that you want. Very big difference. Most people didn't know you can use a life insurance policy as a retirement plan, but you can, right? It's really cool. So it builds cash value that you can use today. It has a retirement kind of, option. Yeah, it has a retirement option, and it still has a death benefit. Do you guys see why I like this so much better than your 401k? So maybe instead of putting money away in your 401k where they charge you all kinds of fees and everything else, put it in this where you have more control over it, and it has this guaranteed death benefit that's completely tax-free to your heirs. I see it as a better vehicle. Your boss, your coworkers, your job, society will make you feel like you're crazy for not putting money in your 401k. They will make you feel like you're a psycho. But when you tell them, I plan on working here for the next 35 years, they will congratulate you. Like, you're not crazy for giving away 35 years of your life to a company who doesn't really care for you, right? You see how it's like backwards. They make you feel crazy for doing what you should be doing. And then the things that you maybe should be not doing so much of, they're like, yeah, do that. Work for this company for the rest of your life. Oh, and then we choose to fire you. Well, go find another job. Like, what? You're not watching out for, you don't care about me? So this is why I had that whole I escaped my 9 to 5 thing. Tisha has a question, hand raised.
Yep. Hey, home.
Hey.
So with that statement, right, with the 401k, like a lot of companies or employers, they offer matching. A really skimpy matching, right?
Sure.
Okay. So what are your thoughts on that? Like, should, because at that point, it's like you're kind of leaving free money on the table if you don't enroll or enlist. So you keep that at like the bare minimum so that you get your employers matching and whatever additional incentives they may offer, but really in terms of like beneficial for you as an individual and like, you know, your real estate goals or financial goals, right? Use a self-directed or life insurance policy, like as you said, as a vehicle.
Well, that is a personal choice. Here's the thing, and here's what
Mm-hmm.
most people don't understand, but great question. What most people don't understand is how the 401ks and the mutual funds charge you.
Mm-hmm.
There's a charge. People don't think about it. They just like give their money and they're like, okay, we're cool. Sometimes the fees for your 401ks are so high that anything that the company was matching for you, it like completely wipes it out. Like your company's match was just enough to pay for the fees within the 401k.
Mm-hmm.
You know, like Vanguard and BlackRock and whatever company that you have your 401k money in, do you notice that they don't live in like their office is not like a little shack, but it's like a giant skyscraper that's beautiful?
Yep.
Guess how they paid for that, right? There are fees from these 401ks, but they don't talk about those. I bet you couldn't even tell me one of the fees. And don't worry, you're not alone. Nobody can. Letitia has a question. Tisha?
No, I was going to say one of the fees. Well, a penalty is if you take it out before you're 63, I think.
59 and a half.
Yeah, and then you get you get taxed, and you get a 10% penalty.
10% penalty. Oh, and that's the other thing that I didn't tell you guys about. That money that I showed you, that retirement income, that's completely tax-free. So it's like a Roth IRA or a Roth 401k. You're pulling that money out tax-free. So though it said 71,000, it's more like 100,000 if you were pulling money from your 401k. Because with your 401k, you would have to pay the tax on it. Jermaine, did you have a question or did you hit unmute?
No, I did have a question. Actually, it's a question that was in the chat. Is there a minimum age in which you can, quote unquote, pull that retirement money out of?
No, that's the other thing. You're pulling out that cash value as a retirement account, or I'm sorry, as a retirement income, but you can pull it out whenever you want because there's no difference between how you've been using it throughout your life to do real estate deals or whatever, and when you pull it out as income. There's no difference. We're just using it in a different way. So instead of pulling the money out and using it for investing in real estate, we're now just using it as income to live.
Okay. The next question is, so essentially, to get a whole life insurance, what's the minimum age? You can be 18
to get a whole life policy?
Yeah.
The minimum age is 16 days old, I believe.
16 days old?
16 days old.
So as an investor, I want to take care, and I want to take care of my family. I can essentially buy an investment property and have that pay for a whole life policy?
Sure.
For my son?
Yep. And we're going to go into that next, Jermaine.
Okay. I'm jumping the gun. My bad. I'm jumping the gun a little bit.
I love it. I love it though, because it just tells me that the flow is all right. Kevin says 15 days old. All right. It might be 15. It might be 16. It's one of those. All of you are beyond that though. But some of you guys might be able to start a newborn soon. So anybody getting pregnant soon? Any one of y'all? So Corey, you got a baby coming? All right. So yeah, let's see. So Paul says it's 30% tax and 10% penalty. Ask me how I know. Right. So you got fees, you got penalties. And then like I was saying, the 401k, the mutual fund, they charge you for having your money with their company. They don't put it out there. That's why you don't know it. And when you see your statement, it doesn't say, oh, this fee and that fee and that fee. It doesn't break it down like that. That's the crazy part. If you guys ever read Tony Robbins' book, Money Master the Game, I think he talks about all the fees. There's like 17 different ones, and most people don't know all of them. So they're feeing your money before it actually grows. Now, if you're not doing anything else, then, I mean, I guess it's not a bad idea. But again, I think the life insurance policy is a much better way to go than the 401k. And me personally, I don't have a 401k. I don't even have an IRA that's tied to the market like that. Because I just don't like it because the costs are just too high. I'm doing the life insurance policy because I believe in the life insurance policy. All right, so let's see. Let's talk about so another way to put it, I want to show you guys, and this is really, this is the thing that gets me excited. So remember when I was telling you guys that 70% of my month or my annual payment, 70% goes to cash value and then 30% goes into death benefit? Well, if you actually take that 12,000 and you multiply it by 70%, 70% of 12,000 is 8,400. 30% is 3,600. So 3,600 is to the death benefit, 8,400 is to cash value. If you guys remember, within year one, my cash value grew by $9,400. So $9,400. That's a 12% return based on the 8,400 that I put in. 3,600 paid for my death benefit, but that 3,600 is paying for my death benefit for the rest of my life, which is crazy because most term policies and whatnot, you're not going to have that policy. It's not, that death benefit's not going to be there for you. The 8,400 goes in. I get 9,400 in the first year, 10,000 the second year, 11,000, 12,000. You see how much this grows? I did the return as a percentage. Look at the growth, the percentage growth. This is what makes me excited. It's how much my cash value grows as a percentage compared to how much I put in. This is why I do this. It gives me access to that much more money. Now, let's go into Jermaine's question. So here is a kid who is a 5-year-old male. This is a policy that they put away $300 a month. This is just an example. You can choose a different amount. I just happen to choose $300 a month randomly. So $300 a month times 12, that's $3,600 a year. Here's the cash value. It grows, 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 grows. Guess what? As you as the parent, you have full control over this money. So though you're like, oh, this is my kid's policy, you have access to this cash value, okay? Now, if you want, like let's say the kid's 29 years old right here, right? 29 years old. They have $146,000 in their cash value. What can you do with that money? You can pay for their wedding. You can buy them a house. You can buy them a car. You can, whatever you want, it's in there for them. You put away $90,000 since then. You can use it for whatever you want. Over here, let's say they're age 18, you want to send them to college, you have this much money in there for college. So this is an alternative to a 529 plan or something like that. The other thing I want you guys to see is if you keep on going and going and going and going, so at some point your kid is going to want to retire. And if you kept putting in $3,600 a year or $300 a month, the total would have been $237,000 over the course of 66 years. The cash value has grown to $1.7 million, almost $1.8 million. Your kid is pulling out almost $140,000 a year tax-free for retirement for the next, it looks like 5, 10, 15, 16-ish years. So let me do 16 years times 137,953. They pulled out $2.2 million and you've only paid into it $237 over the course of their life. And when they die, they still have over $1 million in death benefit. It's bananas. So if you start your kid early enough, you can have a policy like this and not put in that much money. If you can do 300, do 300. If you can do 100, do 100. Whatever you can do, just get in where you fit in, right? So that's a cool thing where parents don't realize that they can actually buy a whole life policy for their kid. And again, it's a whole life policy. You have this death benefit for the rest of their life. You have this income for the rest of their life, the cash value for the rest of their life. Super cool. Super, super cool. Any questions about that death kid policy? Let's see. How does your death benefit grow from year one? So Jason, you still on here? Jason, you said, how does your death benefit grow from year one? What does that question mean exactly? If you can unmute yourself.
Hey,
Hey.
so what I was just so the death benefit from year one, going back, It was at like 500,000.
Mm-hmm.
The next year,
It got
it
more
was
and
at.
more and more.
I could. Yeah. And how does that happen? Like you don't lock in a death benefit.
No,
So
this whole policy, this policy that I have is a unique thing where the death benefit actually grows along with the cash value. And we need that to happen because we want the death benefit to have a certain ratio compared to the cash value. What's confusing sometimes for people is that they're like, oh, when I talk to my agent, I can't do this. I can't do that. I can't touch the money right away, all this kind of stuff. The problem is the agent either doesn't know how or doesn't work with a company that has a policy that does this. That's one of the key things to all of this is having the right agent who knows how this stuff works and will provide you with a policy that grows the right way. Some of the things that you're going to hear is like, oh, I talked to my agent and I'm not allowed to touch my cash value for the first 2 years. I'm like, yeah, you can't. But all of the people who have policies with me, they can. If you guys start this policy, let's say you did a $12,000 a year policy and you're like, Hone, here's $12,000, I put it in. That $9,471 cash value, you can tap into it immediately. Like you're like, here's a check for $12,000 and here's a letter saying that I need to borrow 90% of that. I'm like, okay. And you'll get the money. Like you can send them in at the same time and the money will come. Most policies will not do that. Most policies will not do that at all. Jay Carter asks, I would like to sign up for both policies, adult and child. Awesome. I can help you set that up. Also, how many policies can I have? How much money you got? No, it's you can have 25% of your income. So you can do it that way. If you guys are interested, if anybody is interested, email me. And I'm going to tell you what to email me. But email me at, you can do insurance@honesloans.com. Insurance@honesloans.com. Send me your name, your email, your date of birth, state that you live in, how much you want to spend, how much spend if you smoke or don't smoke. And I think that's it. Oh, and gender. There you go. So email me those things. I can run a policy for you. We can just take an illustration. You guys see all the stuff that I'm showing you. These are like generic ones. They're not generic. They're actually for other people that I've ran it for already. But I can run it for you so that you can see what it does for you or your kids or both. So email me, insurance@honesloans.com, your name, your email, your birth date, the state that you live in, how much you want to spend, whether you smoke or don't smoke, and your gender. It used to be that if you smoke pot, you can't do this. Now you can do it. Crazy how the world works. It used to be an illegal substance and you should go to jail. And now it's like, no, it's cool, bro. You're good. Just if you smoke pot, we'll just label you as a smoker. All right. All right then. Hey, alcohol used to be illegal and then we had the prohibition, whatever, right? So stuff happens. So if you're a pot smoker, don't fear. All right. So let's see. Let's go into so I talked about how you use the policy yourself. I talked about how you can retire from it. I showed you how your kids can benefit from it, how you can start saving for your kids, how you can use their money for your benefit. And then when you're ready, you can relinquish the policy to them. And then it's their policy. The other thing I wanted to show you guys was, let me see. Here we go. Did a nice little quote. I don't remember who said this one, and maybe one of you guys. Give them enough to do anything, but not enough to do nothing. And I'm not sure even if that was the right wording, but essentially, let's say you are a multi-trillionaire. You have all of the money in the world to give to your child. But do you want to give so much money to your child to the point where they don't do anything in life? Absolutely not. You're like setting them up for failure in terms of a person. Now, financially, they can buy all the food and toys and whatever, and they will never want for anything. But are you necessarily doing the right thing as a parent by giving them everything? And I would say, no, you're not, right? No, you're not. And all of the hard work that you guys are doing, they will never learn that if you gave them everything. So the saying is, give them enough to do anything. Hey, Dad, I want to be an astronaut. Okay, here you go. Here's money for astronaut school, right? But don't be like, here's money, just hang out on the couch all day. So don't do that. Okay, so now, how does that work? Well, I want to show you guys this. This is a key thing that most people have never, ever, ever, ever talked about in your life and how you can use this policy. So remember, I want you guys to have this policy for the rest of your life, and I want you guys to do something magical with it, right? So let's say, Jermaine, right? You have this crazy business and you're in your 90s, right? And you're about to croak. So you're like, okay, Hone, I got a plan on my succession plan. And I'm like, well, you got that whole life policy. You're like, yeah, what do I do with it? And you're like, I don't even need these policy loans because I got all this real estate that's making me all kinds of money. So I'm not even taking the policy loans. I got this big ass death benefit and all that kind of stuff. What do I do with this? I say, well, Jermaine, that's a fantastic question. How about we create the Jermaine Little Family Trust or Family Bank? And you're like, oh, what the heck does that mean? I'm like, well, I know how you like entrepreneurship and real estate investing. How about we create a family bank that allows anybody that's in your family to borrow from it to do a business, to create a business or to do real estate investing. Okay. So if this person is your family member and they come to the family bank, they're like, hey, I would like to borrow $100,000. There is going to be a trustee that controls this. So Jermaine, you could be long gone and there will be a trustee here to guard the family bank. There's going to be in here $1 million from your death benefit. You passed away. That money went into a trust. That trust we are calling Jermaine Little Family Bank. There's $1 million in here. This person here is your great, great, great grandson. And he says, yo, I need $100,000. There's a trustee that's not just going to give them the money. They're going to say, what is the money for? If Jermaine Little the seventh brings a business plan and says, I want to start this business. Here's the business plan. I'm going to buy real estate or I'm going to start a restaurant or whatever it is, right? The trustee is going to look at it and say, okay, granted. Boom, here's the money. Here's $100,000. The trustee is not going to stop there. The trustee is also going to pull out a whole life insurance policy on Jermaine Little the seventh. So if Jermaine Little the seventh never pays the loan back, there's going to be a death benefit tied to Jermaine Little the seventh for 1.5 times the loan amount. So he borrowed $100,000 and then he skipped town and he never paid it back. And he didn't start the business. He bought a Porsche and then wrecked it and he died and he never paid back the loan. The death benefit is for 1.5 times the loan amount, which then goes back into the family trust. So now the family bank or family trust is bigger than it was when it first lent the money. Or Jermaine Little the seventh is a savvy investor and decides, you know what, I'm going to do the right thing. I'm going to borrow the money and then I'm going to pay it back. Well, guess what? Jermaine Little the seventh gets to borrow another loan if he wants. Jermaine Little the seventh got one chance. He gets to borrow the loan. If he doesn't pay it back, he doesn't get any more money. What that prevents is for family members to run your name into the ground. All the things that you built up, people will spend your money very fast because you worked hard to build it. They don't care about it. But if you put these processes in place, you can create generational wealth and a family bank that will enable your children to not have to worry and work so hard. I've read a post recently that said, we're out here grinding with no inheritance, with no hand-me-downs, no nothing. We're out here doing it from scratch. Great. I don't want to knock your hustle. That's fantastic. But why? Why was that the case? Why was that the case that you have to grind with no help? It's because your family prior to didn't set up the situation where there was inheritance, that there was a trust fund, there wasn't anything. As noble as that post was, that's not necessarily how I want to set my family up. I would love for my family to have all of the leverage that they can get, as long as they use it wisely. So again, they get to borrow the money one time, or one loan at a time. If they pay it back, they can take another one. They pay it back, they can take another one. Fantastic. If they don't pay it back, well, you messed up, right? You better work for it and bootstrap your way after that. But I want it so that they can borrow the money like that. All right, so we have some questions. Okay, so people are saying JP Morgan said it, and then Warren Buffett. So, and then they said Google Warren Buffett. All right, cool. Paul says, oh, that's why banks have so many VPs. The bank will get a policy to cover the potential loss of the important or needed person. So banks, corporations, all that, they have key man insurance. They have all kinds of stuff like that. Yep. So they'll cover the death of one of their key employees. Hanan says, I might have missed this, but what happens when you don't pay back the loan? What is the average interest when you take out the money, when you pay it back? If there is interest. There's 5% interest on the loan. And if you don't pay back the loan and you die, the death benefit pays back the loan. So you don't have to pay back the loan at any given increment. And the retirement plan is actually where you're pulling out the money and you never pay it back, and then you die. And the death benefit pays off all of the loans. Jermaine, did you have a question?
I did. So in the situation with the family bank, one, can you have more than one policy going into that family bank?
Yes, because the beneficiary of the death benefit could be the trust. And you can have multiple family members all put their death benefit or beneficiary to be the trust.
Okay. So, and my second question is, when a family member does borrow from it, you said they take a policy out on that member.
Yes.
When that member pays it back, does the policy still hold?
Is there
still a policy on that member?
Yeah, like it can still have a policy for sure if
Okay.
if they want, or they can not pay into it anymore. Yeah. Yep. They can buy policy temporarily, or they can allow the policy to continue. It's up to them. But it's kind of like what Paul was saying with the key man insurance, where this person in your family is a valuable person. And so they're going to, they have an interest in that person. Like the death of that person would cause a financial hardship on you. So you're allowed to take out a life insurance policy on that person. So
okay. So can that family bank be set up before you die?
Yes. And actually it has to be, because you have to figure that out. So,
well, yeah. But it can be set up, and can I set that up and actually use that myself?
Yeah. So the beneficiary would be your trust, right?
Mm-hmm.
The beneficiary of the death benefit would be your trust.
Uh-huh.
But until you die, that trust is kind of just sitting there waiting. And then you have all the cash value to do whatever you want with it until you die. Yeah. So that family bank is funded with your death benefit.
Okay.
Yep. Rowan says, things I wish I learned in school earlier. Here's the thing, Rowan, and you're still young. There's a lot of adults that never learn this stuff either. Like they went throughout their whole entire life just never hearing. Jermaine's like, huh? And Jermaine's almost 40. Like it happens. I don't like, He's like, not yet. I know how old Jermaine is because Jermaine and I went to 5th grade together. So we were in 5th grade till 8th grade, and then he went this way and I went that way. But yeah, almost 40. But yeah, a lot of people, you're never going to stumble across family bank and trust and this and that. So this is why I bring this to you guys. Corey, what's going on? You're on mute.
Yeah, no, I figured that out. I have a question. So if you list your beneficiary as your spouse today,
Yes.
but later down the line you want to change your beneficiary to your trust,
Sure.
is that possible, or do you
Yes.
have to open a new policy?
Nope. You can change it whenever you want.
Oh, cool.
Yeah.
You hear that, Chels?
So I would have all of you guys list me as the beneficiary and then change it later. Just like, while you're still deciding whether it should be your wife or your kids or your trust, just put me there in the meantime. Just put me there in the meantime. I'll watch out for it. All right. Cool. Any other questions about anything that we went over? Let's see.
This is mind-blowing information right now.
Yeah. Yeah. So I wanted to, let's see, what did I want to talk about? So back to the original kind of like what this call is all about. One, I wanted to introduce you guys to this new kind of concept of using life insurance to do all kinds of cool things, right? So using life insurance to do all these things. And then I want you guys to see that the wealthy just do things a little differently with different tools that are available to you. You just didn't know that you could do that with these. And then hopefully what I shared with you guys is enough to make you guys interested in getting started, because the key to this whole thing is time. So do you remember in the policies you put in 12,000 and then the cash value is 9,000, and then you put in 12,000, then the cash value is like add 10,000, 11,000, and it takes like time to grow. Well, if you start next year, then you've delayed the growth by a year. If you start 2 years from now, you've delayed it. So the most important thing is that you guys start. The problem is a lot of people are like, they think about it, I'll get back to you, blah, 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 blah. It's bad. It's like they just put it off, and you waste a lot of time. I'm upset because I didn't learn about this until recently. But I also never ran into the right person. I didn't run into the person I needed to run into until recently. And you guys didn't run into me, the version I am now, until I became me. But if you're not necessarily better off if you had started with a different agent, because getting with the wrong agent will cost you money too, because they're going to create a policy that's not so efficient. Paul asked a question, do you have any other resources about family banking? So there's a book called What Would the Rockefellers Do? That's one. What Would the Rockefellers Do? And then the other book is called, maybe if you Google Infinite Banking, that's another one. But it's not about family bank, but infinite banking is another way of doing it. But what would the Rockefellers do is probably the one that comes to mind immediately. It's by Garrett Gunderson for family banking. This is how the rich have created these legacies. These like legacies that last for decades. It's like, how come they still have so much money? Because most families spend all the money, no matter how much they make. They can make trillions of dollars. Within 2 generations, all the money's gone. So how do you have that money last 6, 7, 8 generations, 9 generations? How do you do that? Well, one way is by showing that. Jay asked the question, do I have to cancel my current term policy? You do not have to cancel your current term policies if you don't want to, but let me run you a new term policy, right? Let me run you a new term policy to see if my term policy is better than your term policy, and then you can have both a term policy and a whole life. So there are reasons to do that, and we can go into it, but like I have both. I have a term policy and a whole life policy. And you may have to run one too, because here's one reason. The policy that you have for your kid compared to you, there needs to be like a little bit of a ratio. So in order for you to have a kid policy, you need to have a certain amount of death benefit. Sometimes in order to get that much death benefit, you may not be able to get the full amount using whole life policies because it might be too much money out of pocket every single month. So the way we do it is we add a term policy to your whole life policy for you to be able to get your kid policy. That may not stick right away, what I just said, but give it some time, give your brain some time while you're taking a shower, it'll make sense. Corey posted, Becoming Your Own Banker, Unlock Infinite Banking Concepts by R. Nelson Nash. Yeah, he was like the godfather of infinite banking concept using whole life insurance policies. So his book definitely could steer you in the right direction. And there's like a million other books and YouTube videos out there that you can definitely look into. I'm going to go through this slide very quickly. So whole life versus term, common comparisons. Hone, why should I buy a whole life policy? Why don't I just buy term and then invest the rest? Well, one, because they're completely different things, right? Completely different things. It's like, Hone, why would I buy a Ferrari when I can take the bus? It's just completely different things. Sometimes you want to take the bus and sometimes you want to drive a Ferrari. The life insurance policies, right? So a term policy only has death benefit. That's it. That's all it has. And it has a finite time period. So if you buy a term policy, it's probably going to be for 20 years. So Jermaine, let's say you were 40 years old and you bought a 20-year policy. If you don't die by the age of 60, you've just wasted all that money. Okay? So look at it that way. They say term is cheap. I want to say, yes, it is cheap, meaning not that valuable, because every dollar that you put into your term policy, if you don't die within that period, you have wasted all your money. It is not very valuable. It's a form of protection, but the likelihood of you using it is very low. And they actually did a statistic. 1.1% of all people with term ever use the death benefit. 1.1%. So very, very low. Whole life, if you pay into a whole life policy, you will die at some point, and as long as you keep your policy current, it will cover you. Right? It will cover you. So as long as you have a policy, it will cover you. It doesn't matter if you're 99 years old, it will still be there for you, versus term, it will not. Also, term doesn't build any cash value. You can't use it to do infinite banking. You can't use it to buy real estate. You can't use it to do any of that kind of stuff. So completely different things. You use a term policy for one thing, you use a whole life policy for something else. Whole life versus IUL, we talked about it earlier. Whole life has a flat fee all the way across, whereas an IUL, the premium goes up over time. So right when you want it to grow at the worst possible time, that's when IUL grows in terms of cost, because it's a renewing term policy. As the older you get, the more expensive it costs. A whole life policy, it's a flat fixed fee for your whole entire life. Whole life versus mutual funds and self-directed IRAs and all that kind of stuff. Well, a whole life versus your 401k, we already talked about. The 401k has fees. You can't really use it for investing. There's a whole bunch of things that you can't really do with it. And then whole life versus real estate investing, people often say like, Hone, I can do so much better than the returns of a whole life policy in real estate investing. Yes, but why don't you use a whole life policy to allow you to do more real estate investing? It's not one or the other. I'm showing you how to use a whole life policy to invest in real estate. I'm not saying I'm not telling you to choose one versus the other. I'm saying use the one to help you do the other. So those are some of the wrap ups. All right. Well, you guys notice people have dropped off slowly, right? At this point, I would have been like, oh, guys, everybody turn your cameras on. And I was like, dang, I missed, like half of the people are gone. So that's why I was so excited that I was able to take a picture early on. We got a question from Corey Kirby. Do you suggest taking out a term policy to cover large debt in intended period of repayment, i.e. mortgage. So some people do that, meaning if you have a mortgage that has X amount of payment or debt principal, and let's say you had 20 years left and you take out a 20-year term policy, in the event that you pass away before it gets paid off, this way your family isn't left with the burden of that debt, so that their lifestyle stays intact. Sure, I can see that. The other thing that people do is, if you have young kids, maybe your kid is 5 years old and you're like, well, if I get a 20-year term policy, my kid will be 25 years old by the time that thing's over. At that point, my kid better be able to take care of himself, right? So that 20-year will carry them into an adult. So like if you pass away before that time, though you're not around, there will be a bunch of money for them. Not the same, but you guys get what I'm saying. So yeah, those are a couple of ways you can use a term policy. The other way that I like using a term policy is by having a big term policy. I can convert parts of that term policy into a whole life policy later on in the future. But what I'm doing is I'm locking in my health status. So these insurance policies are based off of your health status. And sometimes you become ineligible for life insurance because of your health. If you become, like, if you have cancer or HIV or something like that down the line, you can't be covered anymore. They're not going to give you life insurance. But if you buy a term insurance policy, you can always convert that into a whole life policy later on. Maybe you buy a $2 million term policy. In order to have a $2 million whole life policy, might be, I don't know, $40,000, $30,000 a year. It might be a little bit more than you want to spend. So instead of getting it right now, just lock in that term policy, convert it later when you make more money. But what you're doing is you're locking in the certainty of your health today. Jason says, what if you can no longer fund your account after 9 years or whatever? Will it still grow, and will you still have the policy? So at some point, it will create enough dividend to pay for itself. So it's around either the 9 or the 11-year mark or something like that. For the kid policy, it takes a little longer. I think that takes like 12 years. But if you stop paying for it, there's enough dividend that comes in that is cash to you that you can actually use to pay your policy. Paul says, is there a way to pay premiums using pre-tax dollars? The answer is yes, right? So he just said it. Have your business pay it as an expense. But who is it giving it to? It's giving it to you as an employee. You as an employee now have to show the policy as income. So now you have to pay taxes as an employee because of this additional income. It's kind of like when a company gives you a company car. You have to pay the taxes on the company car. Same thing when that happens, right? Jason says, is the dividend tax-free? The answer is yes. And the reason the dividend is tax-free is they did this clever little thing. When they give you the dividend, they label it as overpayment of premium. So you've paid taxes on your premium, right? The premium is after tax dollars. You pay the premium. And then when they give you the dividend, they said, oh, you gave too much money. Here's your money back. They can do that because this is what's called a mutual life insurance company. Any policy holders own a part of the company. And so when they give you the dividend, they're just giving you back your premium because you're a part of the company. You own a part of the company. So they're just giving back you overpaying your policy. Call it what they will, whatever. It's tax-free though. So those are little caveats. All very good questions. I like where you guys are all going with like the tax questions and all that kind of stuff. It's important to know because you want to see how do you maximize these things. And yeah, Paul, a lot of people ask that question. Can I pay with this pre-tax? Can my business expense it? And I always say, yeah. But then the employee has to write it on. So I know that game. It's a good game to play. It's a good game. Yep. So with that, guys, I think that's the end. Make sure you guys email me all that stuff. Thank you, Jermaine. Thanks. Glad you guys all stayed till the end. You guys are ride or die. I'm interested to see who gets started with this thing, because all of this information is fantastic and does nothing if you do nothing. So take the step, get the policy. Tisha, you're very welcome. Paul says, great show from Houdini. Yep. We're a bunch of nerds, huh? Bunch of nerds sitting on a, what day is this? Monday. 2-hour long call about life insurance.
Nerds about money.
It's about money. Right. Right. All right. Hold on. See you tomorrow. Study group.
Thanks, Home.
Yep. Thank you, guys.